Hello and welcome. You're tuned into CNBC TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha Gupta, back with your daily dose of commodities, cryptos and currencies. The big tech earnings, mega cap tech giants Alphabet, Meta and Microsoft each reported quarterly results. The Dow Jones Industrial Average rolled over, ending the day down around 0.2% or about 74 points lower. After that, it briefly touched a record high earlier. The S&P 500 ended the day quite flat. While the Nasdaq closed up nearly 0.6%, the stocks in Asia-Pacific are largely in the red following commentary from that high-stakes meeting between Donald Trump and Xi Jinping. Trump said that he had reached a one-year agreement with China on rare earths and critical minerals and cut fentanyl tariffs on Beijing to about 10% after their meeting in South Korea. Back home, the Nifty is hovering around that 26,000 marks, as you can see on your screens. Let's welcome on board Jeffrey Christian. He is managing partner at CPM Group. Jeffrey, hi, thank you so much for joining in. And it's been a very, very volatile year, 2025, to say the least. Gold has gone from 2650 in the beginning of this year to 4380 of an all-time high. And then we are dealing with some correction right now. Would you say that the volatility is far from over and 2026 perhaps could be opening the same way?
I'd say the volatility is far from over. Our expectation is that the price is going to continue to rise and it's going to continue to be extremely volatile. We saw $400 up 2 weeks ago and $400 down last week. I'm not sure if we will see that kind of volatility in the near term, but that has demonstrated how fast this market can move in both directions.
Oh, absolutely. Jeffrey, also, almost nobody is talking about the government shutdown right now. I mean, we're entering into week after week onto this one. What is your view on the U.S. government shutdown? How do you think that can impact the gold prices going forward from here?
Well, I think the U.S. shutdown, government shutdown, is extremely problematic for the overall economy, both within the United States and on a global basis. Every week cuts off, reduces U.S. economic output by 0.1 to 0.2%. So we have already shaved up to 0.8% off of our GDP, and our GDP was already suffering from reductions in employment, reductions in business investment, reductions in the housing market, and reductions in a host of other applications. So we already had a tenuous economic outlook and we were tilting toward a recession. The lockdown doesn't help on a short-term basis and sort of helps push us toward that recession. But in addition to that, on a long-term basis, it severely reduces the credibility of the U.S. government and increases the uncertainties and anxieties that investors and corporations and consumers have around the world. And that will reduce economic activity, not just in the United States, but globally as well, because people are very much concerned about the stability and the direction of the U.S. government.
The other thing to talk about really is the U.S. Fed rate cut cycle, which markets believe has just about begun. We've seen one happen in this week itself. And the current consensus view, it seems, is that it could trigger some more trigger in case of the gold prices going forward. What's your sense? More rate cuts meaning more support to gold?
Our expectation is that the overall economic environment and political environment domestically within the United States, domestically in other countries and globally will continue to deteriorate well into the first half of next year at least, if not longer term. And that kind of deterioration that we're looking at, we expect it will continue to stimulate investor demand for gold and silver worldwide. So if you have bad economic and political environments causing investors to want to buy more gold and silver, you should expect higher prices of gold and silver during the first half of next year and possibly into the second half of next year and beyond.
Since you are so bullish on gold, Jeffrey, would you want to share with us your sense on where the prices of yellow metal are headed by the end of this year and a potential price range for 2026 as well?
We wouldn't be surprised to see $4,500 by the end of this year, possibly somewhat higher. At some point in 2026, we're expecting that the quarterly average price may average $5,000. When we think about when we make our price projections, we have short-term price projections, which are intraday, or this is where we think the price will be this month. But then when we start going longer term, we look at quarterly price projections out over the next 2 years. And then once we go beyond 2 years, we look at annual price projections. And so from a perspective of where we think the price of gold will be in 2026, we wouldn't be surprised to see the price approaching $5,000 on average. And you have to understand that average, and right now the price, we've gone through 10 months of 2025, and the average price is something like $3,600. So people will say, well, the gold price was $4,400 this year. Yeah, for a day or 2 days, actually. But the average is much lower. So if we're saying that we think that the price could approach $5,000 on average next year, that suggests a range that has the gold price going significantly higher than $5,000 on an intraday basis.
All right. Jeffrey, while we have seen a lot of investment demand in case of gold, and that's a reaction really to the gold returns that we've seen in 2025 as well, is a similar story unlikely to fold in next year? What is your sense also on the kind of buying that we've seen by ETFs, by central banks? Do you see that continuing?
Well, first off, central banks have been buying less gold this year. I know there are marketing groups that say that the central banks have been buying like 31, 32, 33 million ounces a year over the last 3 years. That's inaccurate. Central banks have been buying between, say, 8 and 15 million ounces a year over the last 3 years. And this year they're running at a rate of about 6 million ounces because of the higher price for gold. So they tend to be scaled down. In the first 9 months of this year, we saw very strong demand for gold, physical gold from investors worldwide, but physical gold, ETFs, futures, forwards, and options. In the last 2 weeks, when you saw the price go from 3,800 to 4,400 and then back down to 3,900 yesterday, what we saw was much lower physical demand for gold. And most of what we saw were ETFs, futures, and forwards and options pushing the price up and then coming down last week. Those are short-term momentum traders. They were watching the price of gold go from $2,600 at the beginning of the year to $3,600 at the end of September. And they said, okay, this thing is rising more sharply than the stock market, so let's get in there. And they don't want physical gold. They don't want long-term investments. They're looking to get in and be able to get out very quickly. And that means futures, forwards, and ETFs. And that's what we've seen over the last 2 weeks when the price spiked sharply higher and sharply lower.
Let's talk about the silver prices also, Jeffrey, and where do you see those heading? Because while the silver prices will continue to see safe haven buying and the kind of demand that we've seen in gold, but silver also has been playing on industrial demand rhetoric. Do you see that spill over into the next year also?
What we're seeing is flat to lower demand for silver in many industrial applications, including solar power. Solar panels were overbuilt over the last 2 years, and the industry has been living off of inventories of unsold panels that were made over the last 2 years. What we're seeing with the price of silver rising sharply is primarily being driven by investment demand and speculative demand. And that is, again, likely to continue. One of the points I wanted to make when we were talking about gold a second ago, gold has risen 60% or so far this year. Silver has risen very sharply, but platinum and palladium and copper and aluminum, industrial metals, have also risen sharply. The U.S. stock market is at record levels. Bond prices have risen sharply. And the US dollar, which had fallen about 10% in the first 8 months of the year, 6 months of the year, has actually risen a little bit and is now down only about 6 or 7% from where it was at the start of the year. So you've got an interesting situation where gold and silver, which are safe haven investments, have been rising, but industrial metals, stocks, bonds, and the dollar have also been rising. So it's a very interesting market because so many times people say, well, industrial metals and the stocks rise when you have a bullish economic outlook. Gold and silver rise when you have a bearish economic outlook. And the answer is right now, people are short-term bullish and long-term bearish on the economic outlook. And silver is that metal that's in between. It's a financial asset like gold. It trades like gold. It trades like currencies and bonds. But it's also primarily an industrial metal. So it's been pushed and pulled back and forth. And as you know, probably, the Indian market has had tight supplies and supply issues feeding into the jewelry and electronics and chemical catalyst markets where they use silver in fabricated products.
Well, that point is well taken. But what is your sense really on the silver prices going forward then? Are you looking at higher highs the same way as you said about gold in the next year, and where that could lead us in sense of silver?
I think that the silver price is going to stay high for the rest of this year, the last 2 months of this year, and probably move higher next year. I'm not quite sure what our average price is that we're projecting for 2026 in our various reports. But we've seen the silver price move as high as almost to $54. It's come back off. It was trading around 48 something before we got onto this call, and our expectation is that while the silver price will continue to be volatile, and we wouldn't be surprised to see a spike sharply lower at some point on a short-term basis, on a long-term basis, we do see fabrication demand relatively high. Refineries are backed up with scrap, old silver investment products that have been sold to take advantage of these high prices. That's going to work through the market, and that will increase the supply over the next 2 months, 4 months, and that could weigh a little bit on silver prices. But again, the major factor determining silver prices, like gold, as with gold, is investment demand, and investment demand is driven partly by expectations of tight silver supplies, but it's more importantly influenced by investors looking at the state of the world, the state of their own local, financial banking system stability, the state of their own economy, the state of political security. And all of those factors are unsettling investors right now. We've seen a very sharp increase in investment demand for silver this year, last year, this year, and we expect a further sharp increase next year. So we're expecting silver prices to rise. I assume that as I said, I'd have to look at my reports to see what our most recent projection for the average prices next year, but I assume it's well over $50 an ounce.
$50 an ounce is where we could be looking at prices going back in next year. But Jeffrey, you've mentioned base metal prices a lot of times, and people tell us that while 2024 and 25 were the year of precious metals, and we've seen all-time highs in both of these commodities, is 2026 looking like a year of base metals? Are you looking at further gains onto that one? If the US and China trade conversation does go the right way and we see demand coming back, there in any case is a lot of individual fundamentals in sense of supply disruptions for many of these metals. Do you see that demand supporting prices?
Well, I think that I would advise investors to have a core holding some portion of their wealth in physical gold and silver. When we're advising our clients, it really depends on who they are. A lot of our clients are institutional investors or very wealthy family offices, and we will advise them to have a core of physical gold and silver as a financial and political insurance policy. Some portion of their wealth in physical metal that they either hold themselves or they have it in a secure credible, trustworthy depository somewhere. In addition to that, you might have shorter term investments to take advantage of shorter term price moves. But from a perspective of a long term investor, we think that you should always have a core holding of gold and silver. And our historical performance statistics show that it's a surprising amount. It's like 20, 25, 30% of your portfolio in gold and or silver was the optimum percentage of your wealth division in precious metals over the last 40 years, since gold and silver prices were freed at the end of the 60s.
All right. Jeffrey, Indians would be happy to hear you say that core holding in case of precious metals should be in case of physical form. That's exactly most of the Indians buying do as well in sense of gold and silver, buying it in the physical form. Thank you so much for joining in and making sense of what really is that the international markets are looking like in case of gold and silver. And as Jeffrey mentions, it's still going to be bullish in 2026 when it comes to gold and silver. So higher highs is what we can anticipate. Well, with that, we'll slip into a short break. On the other side, all things agriculture commodities is what we will be speaking with Sumit Gupta of WASEDA Global Commodities. Stay tuned. Welcome back. You're tuned into us with the CNBC TV18 Prime, and joining us on the show now is Sumit Gupta. He's CEO at WASEDA Global Commodities. Sumit, thank you so much for joining in. First of all, this whole conversation that we are seeing between US and China and soybean right at the middle of it, I mean, the numbers do sound huge because US produces 118 million tons and it is used to have China buying 22 million tons of that. Now, in this harvest, China hasn't bought at all, and they've rather bought it from Brazil and Argentina. And what we've seen happen in this week as well has been just about 180,000 tons, which doesn't do anything for US. But with this conversation now brewing up, how do you see soybeans moving around in the global markets?
Very good afternoon, Manisha. And a very important question, which is not only related to today agricultural commodities, but in general overall macros worldwide. Because soybean is central to US economy along with corn, and especially the Republican states, they are quite heavy on soybean production. And that is where it becomes a political compulsion for them to take care of their farmers. And we have seen the years from 2016 to 2020 almost where the lower production of soybean was the problem worldwide. But now with Brazil catching up on production, we have seen that China has exercised their right to purchase more soybeans from Argentina and Brazil in lieu of their trade war. And that has led to surplus or not desired surplus in US. To counter that, US government has given biodiesel mandates. They wanted to incentivize more processing, but still overall soybean production worldwide is relatively heavy. I'll say S&D is quite supportive in terms of supplies. And in terms of demand, with China coming in and buying 3 cargoes, which though in overall context means nothing, but it's a signal in that potentially things are easing up. And China still needs to cover for their November, December shipments. And what we have seen that Brazilian bases have gone down on the soybeans because now Brazil expect that China may buy a lot more from US because US soybeans today is the cheapest in the world. So there'll be a realignment of trade for sure.
Absolutely. What is your sense really, Sumit, when it comes to the soybean prices now? We've seen prices run up to a 15-month highs in the global markets in anticipation that China will buy from US. So the US prices have been gaining as well. The conversations are still on, and I'm assuming even if the fine line is signed upon, how much of US soybeans will China eventually buy?
So it's a very important question because if you look at the international prices, it has 2 components. One is Chicago that we watch, and second is basis. South American bases are extremely high of late because China was only buying from Brazil. And with this action, we have seen that US Chicago prices have started going up, which we have seen that it has touched 1080 and nearby numbers. And Brazil bases have come off. One thing that we have to say, it is only a realignment of trade. Now with China buying from US, I believe that Chicago prices will go up. It is supportive Chicago prices. South American bases will go down. I think the oil prices will stabilize because there'll be more beans in soybean in South America to process, which is good for India. And overall, trade will gain more sanctity with more traditional trade flows. And your question, what quantities I expect US to buy? I expect China to buy at least November, December around 8 to 10 million tons minimum, which they need before the new crop arrivals from Brazil. That's the minimum we should expect.
Sumit, would you also say that now with China buying the US soybean, US perhaps would not be pushing India to buy the US soybean?
So yes, absolutely, because as we discussed, farmers is always central to the politics in every country, and for US it is soybeans and corn, and with potentially this trade route opening for US farmer, you might see lesser pressure from US on India for corn and soybeans. And Indian government, I must congratulate, has held up very well as of now. But largely, we have to see that how is our production moving ahead, and how much oil we need, how much meal we need, and what is the poultry demand which is going to be moving up going forward. So there are many factors which are there, which still needs to be considered.
Oh, absolutely. Sumit, one more thing that I want to get your attention on, and that clearly is the yellow peas import duty that India has hiked to 30% now from 1st of November, something that the industry has been asking for a very long time. What does it do to the origin countries now at these current duties?
Before going to Canada, I will first congratulate Indian government the way they have handled, because what is the biggest profession for all of us is to say that government has done something wrong in this way or that way. But this one circular, I will potentially explain how beautifully they have handled. They have said duty will only be applicable on the BL post 31st of October. That means they have given security to the trade that you are not losing money. Number two, they have put in the duty only before chana planting period. Number three, they have resisted all the pressures till date. Number four, industry has done a great job by giving representation continuously to the government about the challenges they are facing. Number five, government of India has been able to keep pulses inflation in check, because with the economic rise of India, you will see protein consumption going up, which has been great service which government of India has done to its consumer. So it's been an excellent policy initiative which government of India has taken. Now coming on the Canada side, Canada has big crops. They have 100% duty on yellow peas imposed by China. India is now 30 or 33% adding the surcharge and all. But still, yellow peas will come to India because overall S&D is still supportive. We need to import yellow peas. The only thing it's going to make is going to make prices a little supportive, which will help pulses farmer across the board, not only limited to yellow peas, but chickpeas and other pulses. And you might see trade taking a sign of relief, and you might see more active trade and going forward. So it's a very positive step for everyone.
A question also on the overall agriculture as a space, because when I look at this year, 2025, Sumit, rice has been declining, multi-year lows onto this one. We've seen palm continue to trade in the negative also when you look at this month, and for this year as well, minor but still in the negative. And that pretty much seems like a case. Sugar prices are down 25 to 30% in this year. Coffee is down, cocoa in some sense in the positive. How are you looking at overall agriculture as a space as we have seen in this year? I mean, that is a chart in front of you now. That is sugar prices down 4%. That's week-on-week numbers as well. Cocoa, coffee, sugar, rice, everything on a declining mode.
Oh, I mean, in India, there is a saying that Bhau Bhagwan Che. And why? Because most of us in India believe in market going up. Okay. And what is the trader's friend is a volatility. And if you see specifically at the monsoon chart of India and Indian commodity price chart, okay, usually in La Nina years, we get big production and our production goes up and prices stabilizes. But worldwide production goes down, which has not happened this year because of the overlapping between La Nina cycles. And because of that, global prices are also low and Indian prices are also low. One, what does it mean? It means in India, it is not because of planning, it is because of Indradev. Okay, it is because of the rain gods. And that is where we have to see that how we move from a chance-based situation to a planning-based situation, where this kind of year should be used to build up our stocks. I will give you one very ballpark number. Today, we consume around 100 million tons of wheat, and we have stocks of around, we keep end year stocks between 10 to 12 million tons, which this year may be around 15 million tons, which is around 15% of our consumption. What is our buffer stock in pulses against a consumption of 30 million tons? Going by same ratio and higher volatility, it should be around 4 million tons, but it is zero. The point that I'm trying to highlight that we should not worry about low prices this year, but we should see it as an opportunity where processors will expand their capacity, consumption will go up. But we should, in a year of bountiful rains and production, should plan for a year ahead. The year which will bring its own uncertainty, and it can be a bigger problem for government because if inflation numbers have come down so sharply, prices have come down so sharply, a small change in production can make prices go up steeply, and which will look extremely bad on food inflation. So, are we sowing the seeds for our own disaster? Is the question that we have to answer. But largely, low prices are welcomed by the manufacturer and processor and Indian consumers.
Point taken. Sumit, thank you so much for touching upon very, very important aspects there in the agriculture space. Global headlines really coming in from this one. As far as India goes, well, yes, we've seen a notification come in with the markets anticipating, by the way, that more notifications could perhaps be on way. With that, that's all the time that we have on this show. Thank you so much for watching.